This weekend is the Berkshire Hathaway annual shareholder meeting, and tens of thousands of followers of the Oracle of Omaha will be marching into Nebraska to listen to Warren Buffett speak. Unfortunately, Charlie Munger's not going to be there. Rest in peace. And so a lot of folks are interested. What is going on? What is Warren Buffett up to? What is Berkshire Hathaway doing? Most recently, they actually filed that they're buying shares in Liberty SiriusXM, the Series C shares a few days earlier. It was the Series A. This trades as LSXMK. That's a mouthful, paying around $25 per share, spending millions of dollars to buy these shares. So in this video, I'm going to talk about what is the angle. What does Warren Buffett's team see with buying these shares in Liberty Sirius? And if you enjoy educational investment videos, you're watching Unrivaled Investing. My name is Daniel. Let's dive right in. If you enjoy these types of videos, please make a point of hitting that thumbs up, hit that subscribe button. And so when we understand what is going on with Liberty Sirius, it is primarily a holding company owning over 80% of SiriusXM, which is a audio entertainment business, owning both SiriusXM as well as Pandora. The shares, there are three different series of shares, the A, B, and C. They trade as LSXMA, LSXMB, and LSXMK. So you have these three different share structures, all part of this Liberty Sirius holding company. And when you study Sirius, because this is the core asset of this business, you know, over 80% of the Sirius shares are owned by Liberty. You have the premium subscribers, over 33 million premium subscribers, as well as 150 million listeners tuning into Sirius. So that is, you know, a strong showing, tens of millions of people. But when you want to understand the quantitative aspects of this business, I'd argue it's struggling. Look at total Sirius revenue. You see it's down 1%. This is from the most recent quarter. You see this business is primarily driven by subscriber revenue. 1.5 billion out of the 2.2 billion total revenue is from subscribers paying up, and that did decline most recently. The last few years, you haven't really been talking about significant growth. That said, their Pandora and off-platform segment did grow slightly, but not enough to offset the underlying struggling, I'd say, Sirius business, where people are saying, is this really a subscription I want to pay for? When I look at the qualitative aspects of the business, I turn to AI Ticker Chat to run a quick check on, you know, what should I think of Sirius, or what are some of the concerns I might want to consider. And, you know, the two that obviously jump out to me are the low scores for financial health and track record. And that I think is warranted because Sirius has a lot of debt and also has a very lousy track record. Shareholders in Sirius have been underwater or significantly underperformed over the last few years. So this has not been a pleasant ride. Those are elements I'd want to understand further. So why is Warren Buffett buying Liberty Sirius, this holding company? Well, I think a large part has to do with the special event where later this year, Liberty is expected to say, you know what, there's this complicated structure. Historically, you have this holding company and it owns this Liberty Sirius shares, where it owns 84% of it. And then there are these public shareholders in Sirius that own 16% of the total Sirius. You know, we're just going to get rid of this complexity, and then we're going to own new Sirius. So all these existing Liberty shareholders will then own this new Sirius shares. The existing Sirius shareholders will own, effectively, they will go out from their old shares to the new shares, and you will no longer have these Liberty Media shares. It'll just be this new Sirius shares. Their ownership structure is going down ever so slightly from around 84% to around 81% due to some debt that's existing at Liberty Media. Now, one opportunity that some sharp investors have considered is that Liberty shares are expected to get 8.4 shares of this new Sirius. And Sirius currently trades at around $3.10 per share. That's equivalent of $26 in value versus the Series A shares trading around $25. And the Series C shares are around the same price. So effectively, you're talking about getting $1, locking that in if, let's say, you were to theoretically sell short the Sirius shares and buy, sell short, let's say 8 shares of Sirius and then buy 1 Liberty share, you're effectively locking in that $1 in gain. But they might be playing for a different story. Is that locking in that type of arbitrage worth it? Because, it is an interesting theoretical. because what you're really talking about is a business where you're not really making a bet on the underlying aspects of the business. You're making a bet on a deal closing. So let me talk about that in just a second. Is this worth it for you to personally consider? First of all, and full disclosure, this is not financial advice. I don't own an interest in any of the stocks mentioned in this video. Also, quick plug, earlier this week, Thomas P. emailed me saying, I'm a longtime listener and think you do a great job as a thoughtful and disciplined investor and make a lot of sense with the points you make. This follows A. Woods, a premium member of Unrivaled Investing, previously commenting that thanks to Unrivaled Investing, I'm currently ahead of my investing goals to retire at age 45. I appreciate the kind feedback from my subscribers. If you're interested in compelling investment ideas, come check out unrivaledinvesting.com. And so, one aspect that you want to consider if you are going to consider this type of arbitrage opportunity. Arbitrage is the opportunity, and this has been going on for centuries now, where people would say, hey, one market I can buy this, and another market I could sell this, and if it's effectively the same good, maybe I can make some sort of spread because in one market it's trading at a different price than the other and it's the same good. That's what you're effectively creating here with this Liberty Sirius versus Sirius, where you could say, hey, I could buy Liberty and short Sirius. Maybe there's an opportunity there. So the first question I actually had thinking about that is, did management comment on the timing of the deal closure? Once again, checking out with AI Ticker Chat, their chat feature, looking at the most recent conference calls, and it quickly calls out management calling out that they do expect the deal to close in early third quarter of this year. So that does make an interesting development. So, I'm looking at this thinking, okay, I can pay for Liberty, pay effectively $25 and get that $26 worth of Sirius in a couple months from now. So that's a 4% total return annualized, given that it might be just 3 months. You're really talking about a potential 12% type of return over this time. The challenge is that if you borrow the shares, there's always, frictions in Wall Street. There's commissions. There's, if you were to short the shares, there's going to be that borrow cost that you have with Sirius, and that is currently over 10%. So I think the Wall Street is adjusting to investors, trying to put on this arbitrage trade in size. That said, it's not clear to me that this is the sole reason that Berkshire is making this bet. I don't think it's purely from the arbitrage, because when I look at their holdings, and this was from the most recent quarter that's available, I believe that's fourth quarter 2023, you could see that they actually owned, yes, they did own a couple $1 billion stake in Liberty Media via the Series C and the Series A, which they were buying more of, but they had also bought shares in the Series stock. So if they were putting on this arbitrage, they wouldn't be buying the shares in Sirius, I would think. So this makes me think that they're actually making a bet on Sirius. Now, thinking about that, is that a compelling bet? That's much tougher for me, because based on the current value for Liberty and where Sirius is trading, you're effectively creating the Sirius franchise at around $10 billion market cap. There's a lot more debt that you need to throw on it, because John Malone loves throwing on a lot of debt with companies. He doesn't want to pay a lot of taxes, so maximize interest expense, offset your taxes. That's sort of been the model. Make a very levered play. But I don't like levered plays on companies that, arguably aren't growing significantly. And you look at this free cash flow profile, and it's been down over several years. And most recently, you're talking about a little bit over $1 billion in free cash flow that they were guiding to. And so $10 billion, let's say, market cap versus $1 billion free cash flow. So you're really talking about maybe high single digits free cash flow multiple for a stagnant business. And so if you believe Sirius can continue to see either stabilize the business, maybe grow their advertising business, grow their Pandora segment, then you could say, hey, maybe this could actually work out very well, because maybe you get multiple expansion, you get that free cash flow to you potentially as a shareholder. Potentially they have to use a lot of that free cash flow to actually pay down their debt. So you have those dynamics where, because it's such a low multiple, maybe there's tremendous upside. Such a low multiple to free cash flow, maybe there's a lot of upside. That said, I just don't like these types of situations. Here's a recent press release slide from Spotify, arguably one of their largest competitors, and they're just growing gangbusters. I mean, they're still doing extremely well. And I think, this follows, the looks from, YouTube talking about their premium subscription, Apple, each of these services, these audio premium offerings are growing arguably much faster than Sirius. And that is the huge red flag. That means I personally will not be participating in this space. Even if it gets super cheap, I'm not comfortable with that dynamic unless it were trading at like 1 times free cash flow or 2 times free cash flow, where you say, hey, even if, the business 5-10 years from now, it doesn't exist, because that free cash flow can go to me, over the next year, I get that payout. But at 10 times free cash flow, the picture just isn't there. I'm just not seeing it, especially when you see, look here, once again, Spotify's growing by 20%. Their premium segment's growing by 20%. Their ad-supported revenue's growing by nearly 20%. Gross profit up 30%. So I just look at this, and it's, when you see the barbarians at the gate, slowly ripping apart your kingdom, what was once a beautiful business model, I think it's important to reassess. And for me, that's, it does make me wonder a little bit about the management at Berkshire. I recognize Warren Buffett is the greatest of all time. One of the greatest of all times. Stanley Druckenmiller, Warren Buffett. Very different approaches. But it does, concern me, in all honesty, seeing, multi-billion-dollar bets on these levered, no growth or limited growth plays. Just for example, Apple also recently reported revenue decline, huge share buyback. Yes, Apple has worked out very well, in large part because the valuation has expanded a lot since Buffett bought it. But I just look at this and I wonder if it would have been better off. And this is a conversation I've had with various different Berkshire shareholders for years, which is that Berkshire for years has been building up a huge cash balance, tens of billions of dollars, hundreds, over $100 billion. And now it's really great for them because they're getting their, significant yield on that cash. But the mindset behind that is, rule number one is never lose money. And rule number 2 is never forget rule number 1. And that is deeply engraved, in Warren Buffett's mind. So only make bets where you're super confident you're not going to lose money. But arguably, he could have been better off saying, you know what, I'm not 100% sure if I'm going to lose money on this, but it is growing very quickly. It is taking market share. I'm not 100% sure on how this business model will play out, but let's own it. Or let's at least take a speculative position on it. And case in point that, people talk about, oh, well, he's out of touch. The thing that's funny is he actually, during the .com implosion, he bought, I'm pretty sure, distressed Amazon bonds. So Amazon.com bonds, because he's like, oh, I'm for sure going to get paid back with Amazon, because he's looking at the balance sheet. But he would have been better off buying the equity, or at least doing some sort of, Texas hedge, like buying the bond and buying the stock, where, if you're right, and that could have just been a game changer for them. And then that could have been something where he just funnels more and more free cash flow into that. So that trade-off of saying, hey, I need to make sure I don't lose money versus making more, let's say, diversified bets on things that are rapidly transforming the world. I'm not saying you need to shoot for the moon and say, take that super high risk bet. I'm just saying an educated bet. And it's just something I've been reflecting on with Berkshire. Now, they're going to do, I suspect they're going to continue to do quite well. And I've done previous videos on Berkshire where I called out like, hey, I do like this setup. And the stock has done very well since those videos. But I just look at this type of dynamic, and personally, I would rather Berkshire, if I were, let's say, a big, if I had a big bet on Berkshire, I would rather see them making investments in fields where I said, oh, this is going to be much, much bigger in the years ahead. This has a chance to be 10, 100x bigger in the years ahead, versus something like, serious where it's like this business is heavily indebted and declining. Anywho, I'm not trying to like take away from Warren Buffett. There's a tremendous amount to learn from him, and I look forward to having a little Berkshire streaming party at my house tomorrow. So I look at this and I tremendous respect for Buffett. That hasn't changed. I reflect on some of these investments, and it's not right for my own personal investment journey. If you have a different take, I'd love to hear it in the comments below. Thanks so much for tuning in to Unrivaled Investing. Have a great weekend, folks.